Welcome to the Deep Dive. Today we're embarking on a pretty fascinating journey looking at philanthropy and finance together.
Yeah, the intersection.
Exactly. Our focus is understanding the investment strategy behind, well, one of the world's biggest philanthropic players.
Yeah.
The Bill and Melinda Gates Foundation Trust.
Huge organization.
Huge. And our mission really is to unpack this distinctive mix of investment thinking they use and reveal the, frankly, super concentrated portfolio that lets them have such immense global impact.
Right.
The sources we've looked at, they offer this really compelling glimpse, how Bill Gates' tech background sort of meshes with Warren Buffett's legendary value investing ideas.
It's a fascinating combination.
Totally. So you're going to get direct insights into how a fund this massive temple navigates the markets and, well, what that really means for their long-term goals.
And the scale is just, it's hard to wrap your head around sometimes. Bill Gates' personal net worth, it's over $100 billion.
Yeah.
But more importantly for this, he's donated over $60 billion of that to the foundation since 2000. A lot of that coming straight from his own investments.
Okay, let's unpack this then. We're talking about a fund investing for perpetual impact, not just beating the next quarter.
Mm-hmm.
What makes their approach so different, especially with those two big influences, Gates and Buffett?
Well, at its heart, the strategy is this unique fusion. Gates' tech smarts and Buffett's deep value principles.
Okay.
In this mix, it's led to something pretty striking for a fund this big. A really, really concentrated portfolio.
Concentrated.
Get this. Nearly 2/3 of the entire trust fund is parked in just 3 stocks, outstanding ones, clearly, in their view.
2/3 in 3 stocks. That's almost unheard of for an institution that size. Most would diversify like crazy to spread the risk.
Right.
What's the strategic thinking behind that kind of concentration for a foundation? Is it more than just liking those companies a lot? Does it relate to their sort of perpetual mission?
That's exactly it. For a foundation thinking in terms of generations, not quarters, this concentration lets them do incredibly deep homework on these companies.
Okay.
And maybe even have a bit more influence. It's like they're building this philanthropic fortress with just a few super resilient companies.
A fortress. I like that.
Yeah. It's about picking businesses that can reliably throw off cash for grants forever, pretty much. Not chasing quick wins everywhere. It's profoundly long-term.
That makes a lot of sense. Okay, so high conviction, long-term view. And given Bill Gates' history, maybe it's no surprise where we start looking at their portfolio.
Microsoft,
yeah, the tech giant. It's the bedrock, right?
Right.
A huge slice. 31.1% of the whole portfolio.
Massive.
And obviously the history there. He founded it. And the sources say he steadily added shares since the foundation started back in 2000.
It's right. As of late June, the trust holds about 28.5 million shares. That's worth over $14 billion.
$14 billion.
Yeah. And while the foundation does sell shares sometimes, to fund the grant.
Right, they have to.
They have to, yeah. But they've always kept a really substantial core position in Microsoft.
So beyond just being the original company, what's been driving Microsoft's, really impressive run lately? Everyone talks about AI, but can you break that down a bit?
Absolutely. The stocks hit all-time highs. And yeah, it's mainly strength in AI. They made that huge $10 billion investment in OpenAI early last year.
Right, 2023.
Yeah, and that quickly made their Azure cloud platform the go-to place for AI developers. It's shown incredible growth, 33% in the last quarter alone. And management's basically saying demand is so high and supply is a bit tight that growth is likely going to keep going for a while.
And it's not just Azure, is it? AI seems to be filtering through their whole enterprise software side, too.
Oh, definitely.
Like Microsoft 365 commercial revenues, up double digits, more seats, higher prices.
You're spot on. They've rolled out these specialized AI assistants, they call them copilots.
Right.
For things like GitHub, Dynamics 365. It just makes the software way more powerful. And what's really interesting is Copilot Studio.
What's that?
It lets businesses use their own data to build custom AI assistants. Tailor-made. That just embeds Microsoft even deeper into how companies work.
Okay, so financially, you get strong revenue growth, but even better profit growth because margins are expanding.
Exactly.
Azure's leading the way. Seems like the future blueprint. But thinking ahead, what's the big potential roadblock? What's the challenge that could disrupt that blueprint, according to the sources?
That's a really good question. Demand is obviously red hot, but the pace of AI innovation is just frantic.
Yeah.
So staying ahead, especially in those custom enterprise AI solutions, and fighting off competitors, nimble startups, or, the other cloud giants like Google, Amazon, that's the key challenge, even with their current momentum.
Makes sense. Okay, and valuation. The source mentions a forward PE of about 37. That sounds pretty rich.
It does. It's a premium price, no doubt. But the source argues it's justified.
Why?
Because the company's enterprise software business is just this massive cash cow. It reliably churns out cash, which then funds the super fast expansion and growth of the cloud business, Azure. It's classic, really. Mature, profitable part, funding the high-growth frontier.
Right, that makes sense. Okay, so if Microsoft is the forward-looking high-growth engine, where does the sort of foundational stability come from?
Ah, good transition.
That brings us to the second big holding. Deeply symbolic, too. Berkshire Hathaway.
Buffett's company.
Exactly. 18.4% of the portfolio. And many people know Buffett and Gates are longtime friends, but Buffett's also been a massive donor, over $43 billion since 2006.
It's incredible. And what's unique about his donations is he gives Class B shares of Berkshire.
Okay, the non-voting ones, or less voting.
Less voting, yeah. He keeps control by converting his super voting Class A shares to Class B before he donates them. So his philanthropy happens, the foundation gets the assets, but he doesn't give up control of Berkshire itself.
Clever. And the sources mentioned a specific rule Buffett has about the foundation's grant-making linked to his donations. What's that about?
Yeah, he actually requires the Gates Foundation to pay out grants equal to his donation amount each year, plus an extra 5% of the trust's total assets.
Wow, so that forces the money out the door.
It ensures the capital gets actively used for philanthropy, not just sits there growing. But even with that requirement, the foundation holds a lot of Berkshire 17.1 million shares, worth about $8.3 billion right now.
And Berkshire itself, it's this sprawling holding company, right?
Well,
Lots of different businesses.
Dozens, yeah. And as a group, many are doing really well, operating at a high level, though their insurance part struggled a bit in Q1. Natural disasters like the California wildfires hit them, so the overall Q1 results were a little disappointing because of that.
It's interesting how much value in Berkshire comes from just cash and equivalents. The source said over half its $630-odd billion in liquid investments are T-bills or cash, while Buffett looks for deals.
Yeah, they're sitting on a mountain of cash, but that's actually become a bit of a challenge for them.
How so? Too much money.
Kind of, because Berkshire is so enormous now. Finding companies big enough for them to invest in, where it actually moves the needle on Berkshire's overall results. That's tough.
Right.
The universe of potential investments gets pretty small when you're that big.
And we saw the stock dip a bit recently, didn't we? Since Buffett announced he's stepping down as CEO in, 2026?
Effective January 1, 2026, yeah. Shares have pulled back some.
So what's the valuation look like now for this, legacy company?
Well, it trades around 1.6 times book value. The source notes that's actually historically expensive for Berkshire.
Okay.
And it's apparently why Buffett hasn't been buying back as many shares lately at this price. But there's a counter-argument. Maybe Berkshire deserves a higher multiple now, especially because it's basically unleveraged. They're not really using their insurance float, the premium money they hold.
Right, the free loan.
Exactly. They're not using that for investments like
Yeah.
maybe could. And they have all that cash sitting there, so maybe 1.6 times book isn't actually that expensive anymore.
That's a really interesting point. So even if Buffett thinks it's pricey for buybacks, a long-term holder, like a foundation, might see it differently.
Could be, yeah. Weighing the valuation against that underlying strength and future potential, even post-Buffett.
Okay. Now for the third big one. 16.2% of the portfolio. Waste management.
Yes.
This one feels like the absolute classic value investment, right? The kind Buffett built his reputation on.
Totally.
It's almost funny, isn't it? Bill Gates, Mr. Tech, investing heavily in, garbage collection.
It really highlights that Buffett philosophy, though. A needed service, maybe not glamorous, but indispensable.
Oh.
And potentially a goldmine long-term.
Exactly.
And waste management, it's been a portfolio staple since way back in 2002.
Wow, over 2 decades.
Yeah, classic buy and hold. Steadily grown in value, very few shares sold off. The trust has 32.2 million shares now, worth about $7.3 billion.
And the source talks about its tremendous competitive moat. What's that about? What makes this company so appealing, especially for a foundation needing steady cash flow?
The moat is just rock solid. Waste Management owns this unmatched network of landfills.
Okay.
And getting permits for new landfills is incredibly difficult. expensive, takes forever. NIMBism, regulations.
Right. Nobody wants one nearby.
Exactly. So smaller trash haulers often have to pay waste management to use their landfills. It creates this really reliable revenue stream, almost captive.
So predictable cash flow.
Yeah.
Crucial for grant planning.
Absolutely crucial for that long-term philanthropic planning. Plus, they benefit hugely from scale. Denser pickup routes mean more efficiency.
Lower costs.
Lower costs, which means strong profit margins.
And they grow by buying others too, right? Like that recent Stericycle deal, now WM Healthcare Solutions.
Yeah, that's a big one. And management expects real financial benefits from it. They're predicting $50 million in cross-selling opportunities and $250 million in cost savings, cost synergies from integrating Stericycle. That just makes them even more profitable.
And looking out a few years, management's pretty bullish, predicting faster revenue growth, expanding margins.
Yeah, they see revenue growth picking up to about 9% a year and EBITDA margins widening out through 2027.
Nice.
And all that growth fuels strong free cash flow, which they can then use for, more of those tuck-in acquisitions.
Just more deals.
Yeah, smaller strategic buys that fit right in, reinforces their position, or they can use the cash for their growing dividend or more share buybacks.
Okay, and the valuation?
Right now, its enterprise value is about 15 times expected EBITDA. The source suggests that means the shares are pretty fairly priced. Could be a decent spot for dividend growth investors, looking for that strong free cash flow story.
This has been really eye-opening, digging into the Gates Foundation strategy. The concentration, the mix of tech and value, it's powerful.
Yeah.
But are there any risks or criticisms mentioned about being so concentrated, especially for a foundation with such huge responsibilities?
That's a really important question to ask. I mean, concentration obviously means higher exposure if one of those specific companies hits a rough patch, right?
Yeah, or a whole sector turns down.
Exactly. Like a big regulatory change hitting Microsoft, or maybe some unforeseen environmental issue for waste management that would hurt them more than a diversified fund.
Makes sense.
But interestingly, the source material doesn't really dwell on those criticisms. It focuses much more on the intentionality behind the choices, the deep research.
Okay.
So connecting it to the bigger picture, what really stands out is that purposefulness. Whether it's riding the AI wave with Microsoft or banking on waste management's unshakable moat, the whole strategy just screams deep conviction and long-term thinking. And frankly, there are lessons there for any investor looking for, enduring value and stable returns.
That definitely raises a key question for you listening in. Given these distinct strategies we've talked about, the rapid tech innovation versus the super stable foundational businesses, how might thinking like a foundation with that long-term impact goal shift how you evaluate opportunities?
Yeah, what can you take from their blend of growth and resilience?
Exactly. What lessons can you draw from mixing high-growth tech with these deeply moated value plays? Something to think about.
Definitely.
Well, thank you for joining us on this deep dive. We hope you continue exploring how big money gets put to work strategically for both financial returns and philanthropic good.